For the first time since 2020, we are seeing rates falling across the board. Yes, that's right. Fixed rates are falling, variable rates are falling. Everything is getting cheaper when it comes to getting a mortgage in Canada. But that doesn't mean it's going to stay that way because we're already seeing upward pressure on Canadian bond yields. And I'll explain why in just a second. And by the way, just as a little bit of a foreshadow here, it's largely to do with the American presidential debate. But before we get into it, my name is Nolan Matthias. And if you want the latest Canadian real estate and financial news, this is the place for you. So do me a favor, hit that subscribe button and hit that like button. And if you want the latest rate updates, turn on the notification bells as well so that you get them as soon as they come up. And guess what? There's probably going to be a lot of rate updates in the next little while as bond markets are all over the place and banks, as they're getting closer to their year end, are getting more and more competitive. So let's jump into it and let's go back to that old school format of starting with the news. So I'm going to start by showing you first the most recent article from Business Insider. The bond market is acting like Trump will win. And yes, this is an American article. It has to do with the US election, but it does play a role in Canadian mortgage prices. And I'm going to spell it out for you here real quick. Don't shoot the messenger, whether you're team orange or team blue. The market is pricing in a win from Donald Trump. The reason we know that the market is pricing in that win is because bond yields are increasing, which is an indicator that there's going to be higher interest rates, higher inflation, and stronger growth, or at least an indicator that there will be an expectation of that. And that had bond market yields pretty much across the board going up in the last couple of days, and I'll show you those in a second. But before I do, let me explain this for a second, because yes, what happens in the US does play a role on Canadian interest rates. Now, we've obviously seen that the Bank of Canada is deviating from the US because obviously we have different economies. But let's say President Trump gets elected and the market does indeed get better, prices go up, there's stronger growth. That will ultimately have an impact on Canada because the US is obviously Canada's biggest trading partner. So this is something to watch closely. There is indeed a correlation between what happens in the US election and what will happen with Canadian interest rates. Now, let me take you into the interest rates for a second and show you exactly what's going on here, because this is the Canadian 5-year bond yield. And as you can see, as I take myself out of the frame here, this bond yield over the last 3 months has been a little bit higher. It's come down, it's gone back up. Then we saw a pretty significant drop here around the beginning of June. But as you can see, interest rates are starting to float up a little bit, and this will affect mortgage pricing. But that being said, even though this should affect mortgage pricing, we are seeing mortgage pricing come down on both fixed rate and variable rate mortgages. Now, before I get into those rates, I just want to show you real quickly what is going on with the 2-year and the 3-year bond yields, because many people are flocking to 2 and 3-year rate mortgages. Now, I'll show you a little bit later on as I talk about the bank rates that there are some good 3-year deals out there. But one thing is to note is that these 2 and 3-year bond yields are still higher than the 5-year yields, which is an indicator that the market believes that interest rates are going to remain higher for the next 2 to 3 years than they will be at the end of 5 years. Now, that comes into our mortgage decision process because we have to think about this from the perspective of what's in the best interest of us when we're choosing a mortgage. Do we take a shorter term rate, hoping that rates go down? Do we take a longer term rate and lock in the rates just in case what we hope happens doesn't happen? And that really all comes down to risk tolerance. But I'm going to tell you right now that the 2 and the 3-year strategy are essentially becoming the equivalent of a variable rate strategy. Choosing the shorter term mortgages at 2 to 3 years, given where the pricing is right now, which I'll show you in a minute, is the equivalent of taking a variable rate strategy when the variable rates are priced out of the market. And of course, as I've talked about in the past, you always want to choose the mortgage that is the cheapest at the time that you get the mortgage. That is statistically the best option most of the time. Now, obviously, it wasn't the case in 2020 and 2021, but that was a significant outlier situation. And in general, when the economy is a little bit more normal, like it seems to be right now, you always want to choose the lowest rate that you can get, assuming that you have the risk tolerance to take a short-term rate or a variable rate if it's priced significantly lower than a fixed rate. So with that being said, let's take a look at what is happening with interest rates right now. So we're going to start with our 5-year fixed full feature mortgages. These, for those of you who are new here, are the mortgages that are non-bank mortgages. They aren't B lender mortgages. B is for bank. These are the prime lenders in the industry, the MCAPs, the CMLSs, and the First Nationals of the world. These are the lenders that take the very best clients and have the very best products. And the reason they have the best products is because if they didn't, they wouldn't be able to compete with the big banks. Quite simply, they aren't a household name and they can't skate on their reputation and their marketing budget. So they have to have better products. And often that comes in the form of lower payout penalties and better prepayment privileges. And the lower payout penalties are going to be important if, in fact, interest rates do go down. So keep that in mind when you're choosing a mortgage right now. Because if interest rates go down and you've got a low penalty, you've got an option to get a lower interest rate. But if you've got a big bank mortgage with a massive penalty because of the way that they calculate their penalties, well, you're pretty much stuck for whatever term that you choose and you have no flexibility, no options, and they get to kind of dictate the terms. So let's take a look at the 5-year fixed full feature rates. Now, this is surprising to me. These rates have all come down. Currently on a full featured mortgage, so this is the best mortgage I think you can get in the industry right now. You are looking at 4.89% on an insured mortgage. Now, keep in mind, insured mortgages are always cheaper. They have the least risk for the bank, so they're priced accordingly. Then as you get to 35% down, that's where the risk levels are about the same as having an insured mortgage for the bank. You'll see the pricing similar. And as you start to put less down and get back to that 20% range, you'll start to see that the prices go up. 5.04 with 30% down, 5.09 with 25% down, and 5.19 with 20% down. Now, this right here, this one really surprised me. The uninsurable refinances, $1 million plus, 30-year amortizations. This rate is traditionally significantly higher than all of the other interest rates. But right now, you can get a very, very good deal on an uninsurable mortgage. So this is if you're buying a property that is over $1 million or you're refinancing, you're doing things where the lenders can't back insure the mortgage. So this is a really good deal. I haven't seen pricing like this in several years. And if you're looking at getting an uninsurable mortgage, well, now is about the time to do it because the rates are priced in line with what a 20% down mortgage would be that has back insurance on it. So this one really surprised me. But here's what surprised me more. When the Bank of Canada reduced interest rates in June, well, it was widely expected that they were probably going to do it in June or July. But here's what I didn't expect. I didn't expect at the same time the lenders to increase their discounts, or in other words, give more of a discount off of prime, making interest rates lower. And take a look at what happened here. Insured mortgages are now at prime minus 0.95, which puts them at about 6% on a variable. Then when you get to 35% or more down, you're at prime minus 0.95. And as you can see, all of these rates have dropped. If you're putting 20% down now, you're looking at prime minus 0.65. And uninsurable, you're looking at prime minus 0.4, which is the most competitive pricing that we have seen for pretty much variable rates across the board in years. So this one was really surprising, and it's starting to make the variable rates a little bit more appealing. But again, at 6% versus 5% on a 5-year fixed, is it really that appealing? And I think that if you expect that there's going to be 4 more rate cuts and then a few more after that, so that when you're back to even, you're going to save some money, well, then it might make sense to be taking a variable. But I'll show you a little bit later on here what I think you might be looking at if you do believe that interest rates are going to go down even further. Then getting into the bank rates, and this is where we're talking about the rates that may make sense to take instead of a variable. There's one I want to point out here. So as you can see, these are pretty much priced out of the market, except when you're looking at the 3-year rate. For whatever reason, Scotiabank, who is our preferred big bank lender, they have the best prepayment privileges. They have the best way of charging their mortgage. It's not a collateral mortgage, which means you have more options if you want to move later on. And they have the best variable product because they actually have an adjustable payment like all of the prime lenders I talked about earlier. Well, Scotiabank right now is offering a 5.04% 3-year rate. Now, other banks are also offering this, but their mortgages don't compare to the one that Scotiabank offers. Scotia literally has the best mortgage product in the industry if you're looking at a big bank. If you're not looking at a big bank, there's better products out there, but if you're looking at big banks, Scotia is it. And then when you get to the 4-year fixed, you're looking at 4.99%. The 5-year, you're looking at 4.94. So the 4 and 5-year mortgage, if you're looking at those, it makes sense to get them at a First National or an MCAP instead. But that 3-year rate is priced so significantly lower than all of the other non-bank lenders, the ones with the better mortgages, that if you expect that interest rates are going to go down and you want to take a little bit more of a variable rate strategy, this 3-year rate at Scotiabank makes sense. But if you are going to do that, you need to make sure that you have a plan to be able to get out of that mortgage in 3 years and get into a more competitive mortgage with a non-bank lender. So this is one of the rare times where I might suggest somebody takes a fixed rate mortgage with a big bank just because it is priced so cheaply. But if you take that 3-year fix, keep in mind that you're giving up the extra 2 years that you might get a lower rate on a 5-year fixed at one of the monoline lenders. So you've got to balance out whether it is worth it to not take the added security of the extra 2 years. In my mind, I'd rather take a 5-year fixed with a non-bank lender with a low penalty so I can pay it out, take advantage of lower interest rates, but have a guarantee that if interest rates go down, let's say something happens in the US and the economy is really good and there's lots of inflation and interest rates instead go up, I'd rather have that guarantee of the 5-year fix. But that's just me. It all comes down to your personal risk tolerance and what you believe is going to happen, and then knowing what the worst case scenario could be so that if it does happen, you're prepared for it. Then taking a look at their 10-year mortgages, these are priced significantly higher, even though the bond yield for a 10-year and a 5-year is about the same. They price in a little bit higher margins because it's for a longer period of time. I don't think the 10-year mortgage makes a ton of sense right now, but for some people who want that added security, it might. Then when you take a look at the 5-year adjustable big bank mortgage, it's at prime minus zero point 0.7. This one is way priced out of the market. So obviously there are better options out there with the non-bank lenders. So I would take those, especially considering that if you are looking at variable rate mortgages and there's a chance you might lock in at some point, well, the lock-in rates are going to be significantly better at a First National, an MCAP, or CMLS than they would be at a big bank. At the non-bank lenders, you simply get whatever the best rate they're offering is at the time. With the big banks, you have to negotiate, and very rarely, knowing that you will have a penalty, are they willing to come down to the market rate. So keep that in mind if you're choosing a variable rate with a big bank. Now, if you do decide that you want to take a 3-year mortgage, you're going to need a good mortgage broker. But if you want a great mortgage broker, make sure you check out our company, Mortgage 360. I've got one of the best teams of badass women who care so much about their clients, make sure that there's no stone left unturned, and make sure that there's no surprises in your mortgage that you are unaware of. So if you want to make sure you have a great mortgage broker and that you get all of the information you need to make an informed decision and you get your risk tolerance assessed properly, reach out to us at mortgage360.ca. Now, last but not least, we're going to get into the 5-year fixed discount mortgages. Now, these are also from non-bank lenders, and they almost always have a catch. Just like everything else in life, if you see a super low rate out there, you get what you pay for. There's something that they're taking away or some trick that they have in order to get the profits back from you. Keep this in mind when you're looking at super low discounted 1-year rates that have the mandatory renewal at the lender option. These are the types of mortgages that there's always a catch. And when you've got a mandatory 1% fee if you don't renew, well, that puts you in a situation where they get to dictate the interest rates that you might get 6 months or a year down the road. So always watch out for this stuff when you see a really good deal. There's almost always a catch. If we look at the 5-year fixed discount mortgages, though, and what's a discount mortgage? Well, it's a mortgage that comes with a catch. If you want to know more about that, you can get my book, Mortgage Secrets, for free at mortgagesecrets.ca. I dive into all of that stuff, as well as how to negotiate with a broker and how to negotiate with a bank and how much margin is in it so you know what to ask for when you're negotiating. You can go to mortgagesecrets.ca, get that for free. All you have to do is pay the shipping and handling. But here's the 5-year discounted rates. You can see that they are lower. They're about the price of a cup of coffee or a beer or a glass of wine every single week. That's the difference between 4.64 and 4.89, for example. But these almost always come with a catch that can cost you $10, $15, $20, $30,000 later on. So keep that in mind. You're saving a cup of coffee a week, but you're giving up an opportunity to potentially save more money down the road. So keep that in mind. If you want to look at these, I'm not going to go through them. You can pause here, take a look at all the rates. And here is the variable rate discount mortgages. Again, just hit the pause button if you want to take a look at them. So those are the interest rates for July of 2024. Again, watch this channel for updates. Hit that subscribe button. And if you want to see more about what's going on in the Canadian mortgage market and the real estate market, make sure you check out this video right here.